For decades, the global financial system has operated on a single, quiet assumption that the United States dollar would remain at the center of world trade. Oil was priced in dollars. Debt was settled in dollars. Reserves were held in dollars. And when crises erupted, liquidity flowed through dollar-based systems controlled by Western institutions. This structure did not emerge overnight. It was built carefully, step by step, after World War II, through agreements, institutions, and military-backed trust. The Bretton Woods system anchored currencies to gold through the dollar. Later, when gold backing was removed, the dollar retained its dominance through energy markets, trade settlement, and geopolitical power. For over 50 years, this system appeared unshakable. But history shows that no monetary order lasts forever. Quietly, beyond headlines and political speeches, a parallel financial architecture has been forming. Not in one country, not under one flag, but across a growing coalition of nations that account for a significant share of global population, resources, and production. These nations are known collectively as BRICS: Brazil, Russia, India, China, South Africa, and now an expanding group that includes energy exporters, commodity producers, and regional powers across Asia, the Middle East, Africa, and Latin America. Their goal is not to replace the dollar overnight. Their goal is to reduce dependency on it. And at the center of this effort is something most people in the West have never heard of: a digital trade settlement mechanism often referred to as the unit. Not a cryptocurrency, not a retail currency, not a speculative token, but a state-level settlement instrument designed to move value between nations outside the dollar system. To understand why this matters, we need to understand the problem BRICS nations are trying to solve. The modern financial system is built on trust, but also on control. International trade relies heavily on systems like sub-UIFT, correspondent banking networks, and dollar clearing mechanisms that ultimately pass through Western financial institutions. This gives the United States and its allies immense power. Sanctions can freeze assets. Payments can be blocked. Reserves can be seized. In recent years, this power has been used more frequently. Entire nations have found their foreign exchange reserves immobilized. Trade payments delayed or rejected. Access to global finance restricted not by markets but by policy. For countries watching from the sidelines, the lesson was clear. If your trade savings and reserves depend entirely on another nation's currency and infrastructure, then your sovereignty is conditional. Realization accelerated after 2014, and it exploded after 2022. Suddenly, central banks that had once trusted the neutrality of global finance began asking difficult questions. What happens if we are next? What happens if our reserves are frozen? What happens if our trade payments are blocked? What happens if trust breaks? The answer was not to abandon trade. The answer was to redesign settlement. This is where the unit enters the conversation. Despite rumors and exaggeration online, the unit is not a single physical currency you can hold. It is better understood as a digital accounting unit used between participating central banks and financial institutions. Its purpose is simple in concept, but profound in implication: to settle trade without using the US dollar, to price commodities without roading through dollar markets, to store value in a form that is partially anchored to real assets. According to reported frameworks, the unit is backed by a basket of components. This includes national currencies from participating countries, commodities, and critically physical gold. The often cited figure is 40% gold backing. This does not mean every unit is fully convertible into gold on demand like the classical gold standard. Instead, it means that gold plays a foundational role in the valuation and trust mechanism of the system. Gold is not chosen randomly. Gold has no counterparty risk. Gold cannot be printed. Gold is not issued by any government. For thousands of years, gold functioned as money not because of ideology, but because of physics and scarcity. It is durable, divisible, portable, and universally recognized. In the modern era, gold was pushed aside in favor of fiat currencies, money backed by government decree and central bank credibility. That system worked as long as trust remained high. But trust erodes when debt expands endlessly, when currencies are weaponized, and when inflation silently transfers wealth. Over the past decade, BRICS central banks have been buying gold at a historic pace. Not retail investors. Not hedge funds, central banks. This is not speculation. This is strategy. Gold reserves provide insulation. They provide neutrality. They provide an anchor outside the political system of any single country. The return of gold is not nostalgia. It is risk management. At the same time, technology has changed. Digital settlement systems now allow near instant clearing without relying on legacy Western infrastructure. Projects like mBridge, developed with multiple central banks, demonstrate how cross-border payments can be settled directly between sovereign institutions using distributed ledger technology. These systems do not require S2FT. They do not require dollar clearing. They do not require correspondent banks in New York or London. This is not theory. Pilot programs are already running. Trade between certain countries is already being settled in local currencies or alternative mechanisms. Energy shipments priced outside the dollar are increasing. Bilateral trade agreements now include clauses specifically designed to bypass traditional settlement routes. Each transaction may seem small, but systems do not change all at once. They change at the margins. Then suddenly, the petrodollar system, once the cornerstone of dollar demand, is under pressure. When oil exporters accept payment in multiple currencies, the automatic recycling of dollars weakens. This does not mean the dollar collapses tomorrow. It means its monopoly erodes. And monopolies, once broken, rarely return. Western banking systems are watching this carefully. Liquidity depends on dollar circulation. Government deficits depend on foreign demand for treasuries. When global trade requires fewer dollars, demand for dollar-denominated debt changes. This affects interest rates. It affects inflation. It affects savings. A multipolar currency world does not mean chaos, but it does mean adjustment. For individuals, this shift raises uncomfortable questions. What does savings mean in a system where fiat currencies compete rather than dominate? What happens to purchasing power when real assets regain monetary relevance? What role does gold play, not as speculation, but as insurance? The unit, in this context, is not a weapon. It is a signal that the era of unquestioned monetary dominance is ending, not with a crash, but with a transition. History teaches us that every major monetary shift feels impossible until it happens. The British pound once dominated global trade. Then it didn't. Gold once anchored currencies. Then it was removed. Now pieces of it are returning, not out of ideology, out of necessity. This is not a story of collapse. It is a story of evolution. And those who understand the architecture of change before it becomes obvious are always better positioned than those who react after the fact. To understand why this shift is happening now, we need to look deeper than headlines and politics. Monetary systems do not change because of ideology. They change because existing systems stop serving the needs of those who rely on them. The dollar-based system was built for a world where the United States was the undisputed center of production, energy consumption, military power, and financial stability. In the decades following World War II, this was largely true. The U.S. manufactured goods, exported capital, and absorbed global demand. But the structure of the global economy has changed. Production has shifted east. Supply chains now run through Asia. Energy flows increasingly originate outside the Western sphere, and demographic growth is concentrated in emerging economies rather than developed ones. Yet the financial plumbing remained largely the same. Trade expanded, but settlement stayed centralized. This created an imbalance. Countries that produced real goods accumulated dollar claims. Those claims were then recycled into U.S. debt markets. In theory, this worked as long as dollars retained purchasing power and political neutrality. In practice, cracks began to form. Debt levels in the United States expanded far beyond historical norms. Monetary expansion accelerated after every crisis, and the use of financial sanctions transformed the dollar from a neutral medium into a strategic tool. From the perspective of BRICS nations, the risk became asymmetric. They produced, they exported, they held reserves. But they did not control the system those reserves depended on. This is where the concept of trade settlement, not currency replacement, becomes crucial. The unit is not designed to replace domestic currencies. People in Brazil will still use the real. Russians will still use the ruble. Indians will still use the rupee. Chinese citizens will still use the yuan. The unit exists at a higher level, between central banks, between state-owned enterprises, between sovereign trade partners. It functions as a neutral bridge. Instead of converting local currency into dollars, routing payments through correspondent banks, and exposing transactions to sanctions risk, participating nations can settle trade obligations directly. Value moves digitally. Accounts are balanced. Exposure is reduced. And critically, the system can incorporate real assets as part of its settlement logic. This is where gold's role becomes central again. Modern financial markets are dominated by paper instruments, futures contracts, derivatives, ETFs, claims on claims. In the gold market specifically, paper gold vastly exceeds physical supply. This works as long as few participants demand delivery. But central banks do not buy paper promises. They buy metal. Physical gold held in vaults provides something no fiat instrument can final settlement. No counterparty. No default risk. No political override. When BRICS nations discuss gold backing, they are not talking about nostalgia for the gold standard. They are talking about credibility in a digital age. A digital unit backed partially by physical reserves creates trust without requiring blind faith. It anchors value without freezing flexibility. This hybrid approach reflects the reality of modern trade. Commodities matter again. Energy matters again. Food matters again. Rare earths matter again. For decades, financialization pushed real assets into the background. Value was created through leveraged derivatives and asset inflation. But when supply chains break and inflation rises, reality reasserts itself. BRICS nations understand this because many of them are resource-rich. They produce oil, they mine metals, they grow food, they control strategic inputs. In a multipolar world, those inputs become bargaining power. And settlement systems that reflect real production gain relevance. Technology enables this shift. Distributed ledger systems allow transparent, auditable settlement without centralized control. Unlike cryptocurrencies designed for speculation, These systems are permissioned, state-backed, and purpose-built for wholesale use. Projects like mBridge demonstrate how multiple central banks can transact directly, settling obligations in real time with reduced friction. This bypasses not just SCU-IFT, but the entire legacy structure of correspondent banking. That matters, because SCU-IFT is not a payment system, it is a messaging system. Actual settlement still occurs through layers of intermediaries, each adding cost, delay, and vulnerability. A direct settlement layer collapses this complexity. It reduces cost, it increases speed, and it limits external interference. From a Western perspective, this raises concerns. If fewer transactions require dollars, global demand for dollar liquidity changes. If fewer reserves are held in treasuries, borrowing costs adjust. If energy trade diversifies pricing, the petrodollar feedback loop weakens. None of this implies immediate collapse, but it does imply long-term rebalancing. Inflation is not just a domestic phenomenon, it is global. When a currency loses exclusive demand, its issuer must offer higher yields to attract buyers. That affects government budgets. It affects taxation. It affects social stability. Savings in this environment become vulnerable. For individuals, fiat money represents stored labor. When purchasing power erodes, that stored labor is quietly transferred. This is why central banks are not alone in accumulating real assets. Institutions are diversifying. Sovereign wealth funds are relocating. Long-term investors are rethinking risk. The unit, again, is not the cause. It is a symptom. A symptom of a world where trust must be earned, not assumed. A world where neutrality matters. A world where concentration creates fragility. Multipolar systems are more complex, but also more resilient. No single failure brings everything down. No single authority controls everything. This transition will not be smooth. There will be volatility. There will be misinformation. There will be exaggerated claims on both sides. Some will declare the dollar dead. Others will deny any change at all. Both extremes miss the point. The dollar does not need to disappear for its dominance to decline. It only needs competition. And competition has arrived. Quietly. Incrementally. Systematically. History rarely announces turning points in advance. They become obvious only in hindsight. When future generations look back, they may not point to a single date or event. They may point to a period, a decade, where systems diversified, where gold returned to balance sheets, where digital settlement replaced legacy rails, where economic power redistributed, and where understanding, not fear, determined who adapted and who struggled. This is not financial advice. It is historical observation. Because every monetary system reflects the world that created it, and when the world changes, the system must follow. As this new financial architecture takes shape, one of the most misunderstood aspects is intent. Many assume the emergence of alternative settlement systems signals hostility toward the existing order. In reality, the primary motivation is resilience. Countries do not redesign monetary infrastructure to provoke conflict. They do it to reduce vulnerability. For decades, the global economy functioned on the assumption that finance would remain separate from geopolitics. That assumption no longer holds. When payment systems reserve assets, and clearing mechanisms are used as tools of policy, neutrality disappears. This realization did not happen in isolation. It happened gradually through observation. When sanctions froze sovereign reserves, it demonstrated that assets held abroad were not truly owned. They were conditional. When banks were cut off from messaging systems, it showed that trade could be halted without a single ship being stopped or factory closed. These events reshaped risk calculations at the highest levels. For central bankers and finance ministers, the question became unavoidable: how do you protect national trade and savings in a world where access can be revoked? The answer was not to abandon global trade. It was to decentralize settlement. The unit reflects this philosophy. It is not designed to overthrow the dollar or replace national currencies. It is designed to exist alongside them, reducing exposure to any single point of failure. In this sense, it functions more like infrastructure than money. Railroads do not replace cities. They connect them. Similarly, the unit connects economies without forcing them into a single monetary framework. This is why it is often misunderstood when described as a currency. It does not circulate among consumers. It does not determine wages or retail prices. It does not compete with domestic monetary policy. Its role is narrow but powerful. It settles obligations. It balances accounts. It moves value. And because it is digital, it does so efficiently. The digital component is essential. Modern trade volumes are enormous. Traditional settlement methods were not designed for the scale and speed of today's economy. Delays introduce risk. Intermediaries introduce cost. Complexity introduces fragility. Digital settlement reduces these frictions. But digital systems alone are not enough. Trust must be anchored. This is where the concept of partial asset backing becomes critical. A system backed entirely by fiat promises is vulnerable to the same confidence issues as existing currencies. A system rigidly tied to gold lacks flexibility. The hybrid model attempts to balance both. Gold provides credibility. Currencies provide liquidity. Digital infrastructure provides efficiency. Together, they form a framework suited to modern multipolar trade. The 40% figure often cited should not be interpreted literally in a mechanical sense. It represents a design target, not a guarantee. The actual composition can adjust based on trade volumes, reserve availability, and policy decisions. What matters is direction. Gold is no longer being dismissed as obsolete. It is being reintegrated as a stabilizing element. This reflects a broader trend across central banking. For years, gold was viewed as a relic. Today, it is being accumulated at rates not seen in decades. This is not speculation. It is hedging against systemic risk. The difference between paper gold and physical gold becomes critical here. Paper markets allow price discovery, but they also allow leverage. Physical markets impose discipline. Supply cannot be conjured through contracts. It must be mined, refined, and stored. As demand for physical gold increases, the disconnect between paper pricing and physical availability becomes more visible. This does not imply manipulation. It implies structural tension. And structural tensions tend to resolve eventually, often abruptly. The rise of the unit also intersects with broader de-dollarization efforts. This term is frequently misunderstood. De-dollarization does not mean abandoning the dollar entirely. It means reducing exclusive reliance on it. Trade settled in local currencies. Bilateral swap agreements, regional clearing systems, alternative reserve compositions. Each of these reduces marginal dollar demand. Over time, marginal changes accumulate. The petrodollar system, once a cornerstone of global finance, relied on energy being priced almost exclusively in dollars. This created constant demand for dollar liquidity. That liquidity then recycled into U.S. financial markets. As energy exporters diversify buyers and settlement options, this loop weakens. Again? Not suddenly. Gradually for Western economies, this presents challenges. Fiscal models on cheap borrowing face adjustment. Monetary policy transmission changes. Inflation dynamics evolve. This is not inherently negative, but it requires adaptation. For emerging economies, the shift offers opportunity, reduced exposure to external shocks, greater autonomy in trade, more balanced negotiation power. However, multipolar systems are complex. Coordination becomes harder. Volatility can increase. Competing standards can fragment liquidity. This is why transition periods are often unstable, not because systems collapse, but because new ones are not yet fully established. History provides many examples. The transition from gold-backed currencies to fiat was not smooth. The collapse of Bretton Woods created turbulence. Inflation surged, markets adjusted, yet a new system emerged. Today, we are witnessing another adjustment phase. Digital technology accelerates change, information spreads faster. Markets react quicker, feedback loops tighten. This increases both risk and opportunity. Understanding becomes a strategic advantage. Those who mistake noise for signal may panic. Those who dismiss change entirely may be unprepared. The unit should be viewed neither as a miracle solution nor as a threat. It is an experiment in adaptation. Some aspects will work, others will evolve. But the direction is clear. Financial power is no longer unipolar, and systems built for a unipolar world must adjust. For individuals, this raises personal questions. How to store value, how to manage risk, how to think about long-term purchasing power. There are no universal answers. But awareness matters, because monetary systems shape everyday life in ways most people never see until they change. And when they do, the effects ripple outward. Savings behave differently. Assets reprice. Trade flows shift. Political narratives follow. This is not the end of the dollar, it is the end of exclusivity, and exclusivity has always been temporary. One of the most important lessons from monetary history is that dominance rarely disappears through collapse. It fades through redundancy. Systems that once had no alternatives lose relevance when alternatives become functional. This is the stage the global financial system is entering now. The dollar is not failing. It is being supplemented. For decades, global trade had little choice. If you wanted to transact at scale, you used dollars. If you wanted liquidity, you held dollars. If you wanted access, you complied with dollar-based infrastructure. Today, that is no longer strictly true. When alternatives exist, even imperfect ones, behavior begins to change. Energy exporters start accepting payment in multiple currencies. Manufacturers price contracts in local units. Central banks diversify reserves. Each decision is rational on its own. Collectively, they reshape the system. The unit is a response to this environment. It does not demand adoption. It offers an option. And options reduce leverage. This is why the system is designed for wholesale use. Retail adoption would introduce political risk, regulatory complexity, and volatility. By keeping it within state and institutional channels, stability is prioritized. This also explains why communication around the unit is cautious. Grand announcements create resistance. Incremental implementation avoids disruption. Financial systems are conservative by nature. They change slowly until they don't. The role of China within this framework is often overstated or misunderstood. While China is a major driver of infrastructure and technology, the system is deliberately multilateral. No single country controls it. This is intentional. If the unit were perceived as a tool of one nation, it would recreate the very problem it seeks to solve. Neutrality is essential. This is why gold plays such an important role. Gold does not belong to any government. It does not vote. It does not sanction. It does not default. In a system where trust between nations is imperfect, neutral assets become bridges. The inclusion of commodities beyond gold is also being explored. Energy, metals, and agricultural inputs can be incorporated into settlement frameworks, reflecting the real economy rather than purely financial abstractions. This marks a shift away from financialization. For decades, value was increasingly detached from production. Asset prices rose faster than wages, leverage replaced growth, complexity masked risk. When inflation returned, these distortions became visible. Real assets matter. Supply matters. Logistics matter. In this context, a settlement system anchored partially in physical reality makes sense. Digital does not mean detached, it means efficient. Critics argue that such systems cannot scale globally, that liquidity will fragment, that coordination will fail. These concerns are valid, but they were also raised about the euro, about electronic trading, about globalized supply chains. Systems evolve through iteration. Early versions are imperfect, later versions integrate lessons. What matters is direction, not perfection. The Western financial system is not static either. Central bank digital currencies are being explored. Payment rails are being modernized. Regulatory frameworks are adapting. This is not a zero-sum competition. It is parallel evolution. However, parallel systems reduce dependence, and reduced dependence changes power dynamics. Sanctions become less effective when alternatives exist. Policy influence weakens when compliance is optional. This does not eliminate leverage, it dilutes it. The geopolitical implications are significant. Countries with strong trade networks and resource bases gain autonomy. Countries dependent on external financing face adjustment. Debt dynamics become more sensitive. Interest rates reflect real demand rather than assumed dominance. Inflation becomes harder to export. This could lead to more disciplined fiscal policy or to political strain. Much depends on leadership and adaptation. For individuals, these macro shifts often feel abstract until they aren't. Currency depreciation shows up in grocery bills. Interest rate changes affect mortgages. Asset revaluations impact savings. Understanding the underlying drivers provides context. Fear thrives in confusion. Preparation thrives in clarity. The return of gold as a monetary reference point does not mean a return to the past. It means borrowing what worked and adapting it to modern realities. Hybrid systems are not ideological. They are pragmatic. The unit is one example among many. Regional trade blocs are exploring similar ideas. Digital settlement is becoming standard. Multipolar finance is not coming. It is already here. The question is not whether the system will change. It is how smoothly the transition will occur. History suggests transitions are uneven, but also inevitable. As the global system moves further into this transition, a critical factor often overlooked is psychology. Monetary systems are sustained not only by mechanics, but by belief. Confidence determines velocity. Trust determines stability. When belief shifts, behavior follows. For decades, the belief in dollar permanence was unquestioned. Businesses priced contracts assuming long-term stability. Governments structured budgets around cheap dollar funding. Individuals save without considering currency risk. That era created habits. Breaking habits does not require catastrophe. It requires alternatives that feel safe enough. The unit does not need to dominate global trade to be effective. It only needs to function reliably for a subset of transactions. Once participants trust the mechanism, usage expands organically. This is how systems grow. Not through mandates, through utility. Trust builds through repetition. Settlements clear smoothly. Value transfers without interference. Disputes are resolved. Over time, confidence accumulates. This is why early adoption is limited to strategic sectors. Energy. Infrastructure, sovereign trade, these are areas where settlement risk is highest and incentives for independence are strongest. Consumer payments may never touch the unit. They do not need to. Wholesale systems shape the foundation beneath everyday life. Just as few people think about interbank lending, yet depend on it daily, most will never interact with settlement units, yet feel their effects. Another misconception is that this transition will unfold evenly across regions. It will not. Some economies are structurally prepared. They have trade surpluses, resource bases, and low external debt. Others are heavily leveraged, dependent on capital inflows, and sensitive to interest rates. Divergence increases. This can create tension. Countries that benefit from the old system may resist change. Countries constrained by it will push faster. This dynamic is already visible in global forums. Language shifts, policy signals emerge, reserve disclosures change. Gold holdings rise quietly. These are not accidents. They are preparations. The Western response often oscillates between dismissal and alarm. Some argue nothing has changed. Others warn of imminent collapse. Both positions simplify a complex reality. The dollar's role is evolving, not ending. But evolution implies adaptation. Financial dominance once relied on production, later on markets. Now it relies on trust. Trust must be maintained. Fiscal discipline matters. Monetary credibility matters. Political stability matters. In a world with alternatives, mistakes carry consequences. This is new. For decades, there was no competitor. Now, there is choice discipline systems. It forces efficiency. It exposes weakness. From a global perspective, this could be healthy. Concentrated power creates fragility. Distributed systems absorb shocks better. However, distribution also reduces coordination. Crisis response becomes harder. Liquidity backstops fragment. This trade-off defines multipolarity. The designers of the unit appear aware of this. Integration with existing systems is gradual. Interoperability is emphasized. Redundancy is built in. This is not revolution. It is engineering. The narrative of sudden collapse attracts attention, but it misrepresents reality. Monetary systems unravel slowly, then all at once only in hindsight. What appears sudden is usually the result of long preparation. This preparation phase is what we are witnessing now. Gold accumulation, digital infrastructure, bilateral agreements, alternative messaging systems. None of these alone change the world. Together they do. For individuals, the lesson is not to predict dates or outcomes. It is to understand structure. Fiat currencies are claims. Assets are anchors. Diversification is not speculation. It is resilience. The future is unlikely to belong to a single currency, ideology, or system. It will belong to frameworks that can coexist, adapt, and absorb stress. The unit is one such framework. Not perfect, not dominant, but indicative. It signals a shift away from assumption toward design, away from monopoly toward plurality. History does not repeat, but it rhymes. Empires rise. Systems mature. Alternatives emerge. Those who study the architecture of change gain perspective. Those who ignore it are surprised. The global financial order is not ending. It is rebalancing. And rebalancing always feels uncomfortable to those accustomed to stability. As the rebalancing continues, attention increasingly turns to measurement. How do we know when a system is changing if the change is gradual? The answer lies in indicators rather than headlines. Reserve composition is one such indicator. For decades, central bank reserves were heavily concentrated in dollars and dollar-denominated assets. This concentration reflected trust, liquidity, and convenience. But convenience becomes risk when diversification is ignored. In recent years, reserve disclosures have shown a subtle but persistent trend. Dollar share declines at the margin. Gold share increases. Alternative currencies gain small but meaningful representation. These shifts do not make news because they are incremental. But incremental changes compound. Another indicator is trade invoicing. When contracts are written in local currencies or alternative units, it reduces exposure to exchange risk and settlement interference. This trend is especially visible in energy trade, where volumes are large and margins matter. Settlement infrastructure is a third indicator. The expansion of non-Western messaging systems, bilateral clearing arrangements, and digital settlement pilots reflects preparation, not protest. Infrastructure is built in advance of need, not after. This is a crucial point. Countries do not wait for crisis to redesign plumbing. They prepare quietly, test systems, and scale when conditions require. The unit fits this pattern. Its development is cautious, its rollout limited. Its governance collective. This reduces friction and avoids triggering defensive reactions. The 40% gold backing concept often captures attention, but it is less about a fixed ratio and more about signaling discipline. It communicates that value is not purely abstract, that settlement has a tangible anchor. In a world saturated with debt and derivatives, tangibility matters. Gold's role here is psychological as much as financial. It reassures participants that the system is not infinitely expandable, that there are constraints. Constraints create confidence. Unlimited flexibility creates fragility. This principle applies broadly. Monetary systems that ignore limits eventually encounter them. The question is whether adjustment is proactive or forced. The BRICS approach appears proactive. This does not guarantee success, but it improves odds. Critics often ask whether the unit can survive political differences within BRICS. These nations do not share ideology, governance models, or strategic priorities. Cooperation is complex, yet this diversity may be a strength. A system that accommodates difference is more resilient than one that demands uniformity. Shared interest in trade stability can override political divergence. History shows that commerce often precedes alignment. The European coal and steel community came before the European Union. Trade integration created incentives for cooperation. Similarly, settlement integration can create stability even among rivals. This does not eliminate conflict. It reduces financial escalation. When systems are interlinked, disruption carries mutual cost. This is another reason neutrality matters. The unit is designed to minimize politicization. Its success depends on predictability. For Western institutions, adaptation will be ongoing. Financial centers will compete on efficiency rather than exclusivity. Regulatory frameworks will evolve to maintain relevance. Innovation is not one-sided. Legacy systems have advantages: deep liquidity, established law, and institutional memory. These strengths do not vanish, but they must be leveraged intelligently. Complacency is the real risk. For individuals, the macro story translates into micro choices. Exposure to a single currency or system carries risk. Exposure to real assets carries volatility. Balance becomes essential. There is no universal prescription, but awareness precedes strategy. Understanding the direction of change allows for measured responses rather than reactive ones. The unit should not be feared or celebrated blindly. It should be studied as a case study in how systems adapt under pressure, as an example of how technology and tradition can merge. as a signal of a world moving toward multiplicity. This multiplicity will define the coming decades. Trade will be more regional, finance more modular, currencies more competitive, and power more diffuse. These shifts do not end globalization. They reshape it, globalization without monopoly. Integration without dominance. This is the emerging pattern. As systems diversify, one of the most underestimated forces shaping outcomes is time. Monetary transitions rarely move at a pace that feels dramatic day to day. Yet over years, they fundamentally alter incentives. What looks insignificant in isolation becomes decisive in accumulation. A 1% shift in reserve allocation here, a single bilateral trade agreement there, a pilot settlement program quietly extended. None of these announce the end of anything, but together they redraw the map. This is why those expecting a single event, a crash, an announcement, a declaration, often misunderstand how power actually shifts. Power migrates when alternatives become normal, not when they are announced. The unit's long-term influence does not depend on public awareness. It depends on institutional habit. Once Treasury departments, state enterprises, and central banks integrate a system into routine operations, reversing course becomes difficult. Systems, once embedded, create inertia. This is especially true in trade finance. Letters of credit, settlement cycles, collateral frameworks, these are conservative by design. Change is slow, but once adopted, persistent. The real shift occurs when a new system stops being alternative and becomes simply another option. At that point, the psychological threshold has already been crossed. Another important dimension is legal architecture. Dollar dominance is reinforced not only by liquidity, but by legal predictability. Contracts settled under established jurisdictions carry enforceability advantages. BRICS-aligned systems are responding by building parallel legal frameworks, arbitration mechanisms, and settlement rules. These may not rival Western systems immediately, but they do not need to. They need only be sufficient for participants. Over time, standards evolve. This mirrors earlier transitions in global trade law. Maritime law, insurance frameworks, and clearing standards all emerge through use, not decree. The same process is underway now. Digital settlement accelerates this evolution. Code replaces paperwork. Automated reconciliation reduces disputes. Transparency increases accountability. This reduces reliance on trust in institutions and increases reliance on system design. Design matters. Poorly designed systems fail regardless of intent. So far, the emphasis on incremental rollout suggests caution rather than ambition. That caution reflects an understanding of what is at stake. Monetary credibility, once lost, is difficult to regain. This is why gold's presence is symbolic as well as practical. It communicates seriousness. It signals restraint. It reassures participants that settlement units are not infinite abstractions. In contrast, fiat systems rely heavily on narrative management. Confidence must be continuously reinforced. When narratives fracture, volatility follows. The return of anchoring mechanisms does not eliminate volatility, but it changes its character. Asset-backed elements introduce friction. Friction slows extremes. This may result in fewer bubbles, but also fewer rapid expansions. Trade-offs are unavoidable. From a geopolitical standpoint, multipolar finance reduces the effectiveness of unilateral pressure. This may encourage diplomacy, or it may fragment enforcement. Outcomes depend on behavior, not structure alone. No system guarantees peace or stability, but systems influence incentives. When financial warfare becomes less effective, alternative tools gain prominence. This could lead to more overt conflict, or it could reduce escalation. History offers examples of both. The designers of the unit appear focused on reducing financial vulnerability rather than pursuing advantage. That distinction matters. Defensive systems attract participants more easily than offensive ones. Trust grows when neutrality is demonstrated over time. The coming decade will test this. Crises will occur. Stress points will emerge. How the system responds will determine its longevity. For individuals watching from the outside, the temptation is to search for certainty. But certainty is rare during transitions. What is available is probability, and probability favors systems that align with structural realities. Those realities include a rising global debt, the fragmented geopolitics, a technological acceleration, the resource constraints, the demographic shifts. A financial system that acknowledges these realities is more likely to endure than one that assumes permanence. The unit is an acknowledgement, not a guarantee. As with all transitions, winners and losers will emerge, not because of moral judgment, but because of positioning. Those heavily invested in a single framework face adjustment. Those diversified across systems gain flexibility. Flexibility is the defining advantage of the next era, not dominance, not scale, adaptability. The story unfolding now will not end with a headline. It will end when the new normal feels ordinary. And by then, most will have forgotten there was ever another way. As the new normal slowly takes shape, another subtle but powerful force comes into play: generational transition. Monetary systems are not only inherited by institutions, but by people, and people carry assumptions forward until those assumptions no longer match reality. For older generations, the dollar-centric world feels natural. It is the system they studied, worked in, and trusted. For younger policymakers, traders, And technologists, the idea of a single dominant currency feels increasingly outdated. They grew up in a digital, networked world. Multiplicity is normal to them. This matters because policy direction is influenced by mindset. When decision makers are comfortable with plurality, resistance to alternative systems weakens. This generational shift aligns with technological change. Digital native infrastructure feels intuitive to those who never experienced paper-based systems. Settlement through code is not radical, it is expected. The unit exists at the intersection of these shifts. It is digital by design, multipolar by intent, anchored by tradition. This combination would have been politically impossible decades ago. Today, it feels inevitable. Another factor accelerating this transition is crisis fatigue. Since the early 2000s, the global financial system has endured repeated shocks. Each crisis required extraordinary intervention. Each intervention expanded balance sheets and blurred boundaries. Emergency measures became routine. What was once unthinkable became policy. This eroded confidence in long-term stability, not collapse-level fear, but quiet doubt. Doubt encourages hedging. Hedging encourages diversification. Diversification encourages alternatives. The unit benefits from this environment not because it promises perfection, but because it offers optionality. Optionality is valuable in uncertain systems. Even if the unit only captures a small share of global settlement, its existence changes bargaining dynamics. When counterparties know an alternative exists, negotiations shift. This is true in all systems. Monopoly pricing ends when substitutes appear. Monetary monopoly follows the same logic. This does not require mass adoption. Marginal adoption is enough. Western financial institutions are beginning to acknowledge this, even if publicly understated. Reports emphasize resilience, modernization, and competitiveness. Language shifts from dominance to leadership. Leadership implies persuasion. Dominance implies compulsion. The difference is important. A system that relies on persuasion must perform. Performance becomes the metric. This raises standards. For the dollar system, this means fiscal responsibility, regulatory clarity, and institutional trust become more critical than ever. For alternative systems like the unit, it means proving reliability under stress. Neither path is easy. The transition period is therefore one of testing. Stress will reveal strengths and weaknesses. Early systems often fail before stabilizing. That is normal. The question is not whether failures occur. It is whether lessons are incorporated. The hybrid nature of the unit allows for adjustment. Asset composition can shift. Governance can evolve. Technology can upgrade. Rigid systems break. Adaptive systems bend. This principle applies broadly. For countries, adaptability means reassessing assumptions. Export-led models reserve strategies, and debt structures must align with a more competitive currency environment. For businesses, it means understanding settlement risk, currency exposure, and supply chain dependencies. For individuals, it means recognizing that purchasing power is not guaranteed by tradition. These realizations are uncomfortable, but discomfort often precedes progress. The return of gold to strategic relevance is emblematic of this moment. Gold does not promise growth, it promises preservation. In uncertain times, preservation becomes valuable. This does not mean abandoning innovation, it means anchoring it. The future of finance is unlikely to be purely digital abstraction or purely physical constraint. It will be hybrid, digital rails, physical anchors, plural systems. The unit is one experiment among many in this direction. Its significance lies less in its scale today and more in what it represents. A willingness to redesign, a refusal to assume permanence, a recognition that trust must be maintained, not inherited. History rewards those who adapt early, not those who cling longest. The global financial system is entering its adaptation phase. Not collapsing, not resetting overnight, but evolving. And evolution, while slow, is relentless. As the world adjusts to multipolar finance, one concept becomes increasingly critical: interconnectivity. Modern economies are deeply intertwined. Trade, investment, technology, and finance form a network far more complex than any single nation can control. The unit is designed for this network reality. It is not a standalone tool, it is a bridge between nodes. Each participant, a central bank, a state-owned enterprise, or a sovereign wealth fund, contributes to stability by following agreed protocols. When all nodes cooperate, the network functions smoothly. When trust frays, the network compensates. This is the advantage of digital settlement. Unlike legacy systems that depend on centralized intermediaries, distributed systems reduce single points of failure. They improve transparency.